A warm greeting to everyone. Today, we have a special guest with us, Jeremy, the portfolio manager from UBS, who will be sharing with us more about their US Total Yield Sustainable Equity Strategy and how this strategy utilizes quality stocks to generate a sustainable income. So Jeremy, let's start with a broad macro question. So what is your outlook on the US economy in 2024?
So first off, thanks for having me here today. It's my pleasure to be here, talking with you and your audience. So 2024, two main items. So the first is volatility. And I see two big places for volatility. One, geopolitics. If you think about what's going on in the world, we have what's going on in the Mideast, we have the Red Sea, we have conflicts, armed conflicts across parts of Africa. And also, let's just say we have some tensions between some global superpowers. So I think these are some items that could increase volatility, and especially where we see volatility now. If you looked at volatility at the end of 2023, it wasn't quite at record lows, but it was near record lows, so it's quite low. So it wouldn't take much to get it to spike up a bit. So that's the first one, geopolitical risks. The other is, let's just call it local politics. The exact numbers I've seen vary a little bit, but let's just say it's between 60 and 70 countries are going to hold elections this year. You're going to have more than 2 billion people who are eligible to vote. And this is really like unprecedented in any given year, in like just a 1-year period, right? And you can imagine, and let's be clear, some of these elections have already occurred, right? But there's still many that are still out there in the future. And you can imagine if there's any situation, if there's any conflict or they're not resolved immediately in terms of the outcomes of these elections, there could be some volatility around that, and we could see a pickup in volatility as well. So that's the first item for me that I see out there in the horizon this year, and that's this increasing volatility. The other item is a slowdown in growth, so a modest slowdown. So I think last year, I'm sure you and your audience have heard it as well, people were predicting this soft landing. But we really didn't get that. We actually had a quite strong economy, right? I think it was just delayed a little bit. And so what's going to drive that? So during COVID, we saw that consumers, and the US is a consumer-driven economy, that consumers built up a lot of excess savings, so savings above trend. And this came from primarily two spots. One, and this was a smaller spot, was certain payments, debt payments were postponed, right? And the other thing was really just through transfers. So transfers of money from governments to individuals. So they built up this strong excess savings, so savings above trend. Well, that savings has been spent. It's gone. So we're back at trend levels. And so, this excess capacity to spend is now, it's gone, right? So, but why do I think it's going to be a modest slowdown? And that's because consumer balance sheets are still strong. Also, what you're seeing is that business balance sheets are still relatively strong. And the other thing that I've noticed is that over the last couple of years, last 2-3 years, is that business investment is below trend. So I think you could see businesses, doing a bit more investing this year. And you can imagine areas which you might see this investment, it would be in areas like infrastructure spending or the green energy transition or something everybody's talking about, investing in artificial intelligence. Okay, so for me, it's those two items. It's increasing volatility, a modest slowdown in growth. And what's the implication of all that? It's that you want to buy quality. You want to find quality stocks, quality companies. The reason being is that quality generally outperforms in periods of slowing economic growth, right? So you want to find quality companies. These would be companies that have strong balance sheets, they're highly profitable, and they have stable businesses. So for me, again, it's volatility, a modest slowdown in growth, and then what you want to do, look for quality.
Right. So thank you, Jeremy, for giving us a broad macro outlook. So moving on, what is the approach in investing in the US market?
Sure. So I guess kind of the level set for your audience. So I am a quantitative or rules-driven investor, right? So we use a model to select stocks and identify them. Also, I run primarily, or strategies, my strategies focus on capital return strategies. So we're looking for companies that are returning a large percentage of their market capitalization via dividends and share buybacks. I'll talk a little bit about share buybacks in a minute. So what we're looking for is companies that are essentially spending a lot on dividends and share buybacks relative to their market capitalization. So we're looking at a yield, essentially, right? Now, why share buybacks? What are share buybacks, right? Maybe your audience is a little bit less familiar with them because they're, let's face it, primarily something you see in the United States. So what happens is a company would go out and repurchase or buy its shares in the open markets. So let's just say company XYZ, they're out looking to buy it, and you and I are shareholders, and we sell our shares, right? But instead of you selling it to me or vice versa, it's company XYZ that's out there repurchasing those shares from us. So essentially they've transferred money on their balance sheet to us by repurchasing those shares from us. So that's what a share buyback is in short. Now, why do we care about this? Why do we look at it, right? So if you were to look at dividend yields in the US, what you would see is that they are consistently and persistently lower than in other parts of the world. Why is that? It's because companies are also repurchasing shares. And in fact, if you looked at the number of companies that were doing just a dividend, so paying just a dividend, or they were doing just the share buybacks, and you also looked at the number of companies that were doing both, so they're doing dividends plus share buybacks, what you would see is that the number of companies that do just a dividend or just a share buyback is actually lower than those that do both. So really, what you see in the United States market is that companies are returning capitals two ways, dividends and share buybacks, and the number of companies doing both is more than ones that do just one or the other. And so we've always thought in our process that if you focus on just dividends or just share buybacks, you're missing the entire story. So that's why we focus on both. And lastly, what we're also looking for, and this is really important to me as well, is it's about quality. Because as you can imagine, the level of the yield, it's higher is good. You want to have an attractive yield, right? Yep. But we are concerned, whether it's sustainable. Will a company be able to maintain, the buyback? Will it be able to maintain the dividend in the future? Yep. Right? Because we don't want it to just, be nice and high now, but 6 months from now they're cutting it or it's gone. Yes. Right? So we've always used these quality metrics in our stock selection model along with the yield. So it's the combination of yield and quality. And so again, some of the things we were talking about before in terms of it's about strong balance sheets, it's about profitability, and it's about stable businesses.
Right. So thank you for sharing more about the share buybacks, because I think local investors know more about dividend payouts in Singapore. So thank you. And so moving on next to the next question, given your focus on yield and quality, what do you wish to highlight to our audience regarding the top holdings of this strategy?
Sure. So again, as I mentioned, we are quantitative or rules-based investors on my team. We are using a model to help us find those companies that have the attractive total yields and the strong quality characteristics. Now, what you would see is if you looked at the holdings, you would not see a lot of the Magnificent Seven names that we saw be so impactful on US markets and global markets last year, really. Why? So some of them, they don't fit the capital return theme. So they're just not returning capital to shareholders, and that's fine, right? A few others, in that mix, they are returning a lot of capital. So in an absolute dollar amount, it's large, it's a lot of money. However, their market caps are even larger. So when we look at the yield, when we look at the amount of money that they're returning to shareholders via the dividends and share buybacks, and we look at it relative to their market caps, well, now that absolute dollar amount is relatively modest because they just have such really, really big market caps, right? So the yield is now modest. So, you have the situation where some of those Magnificent Seven, they don't fit the theme of capital return, and others, they don't rank as well in the model because their yields are just modest because of the size of their market caps, right? So we tend not to hold many of them. The stocks that we do hold, they are ones that are they offer more attractive total yields with the strong quality characteristics. So if you looked at the portfolio currently, and this changes over time, but if you were to look at it, currently or definitely at the end of the year, end of 2023, what you'd see is that we have an overweight relative to the index to sectors like industrials and materials, and that's just because we're finding more opportunities in those sectors, say, to find the stocks that have the high total yield or the attractive total yields along with the strong quality characteristics, say, as opposed to some of the other sectors like communication services or information technology. So what is the implication of not holding some of those Magnificent Seven names? So since they're some of the largest names in the index and we're not holding them, it means that we're holding some of the smaller names in the index. What does that get you? So right now, that means that our portfolio is cheap on a price to earnings basis relative to the index because we're not holding some of the more expensive names. Additionally, since we are holding some of these smaller names in the index, typically what you see in some of these names is that they're more sensitive to interest rate moves, right? Because they generally have higher borrowing costs. So, and I think along with most other people, I fully expect that the Fed's going to be cutting rates this year. So as the Fed cuts rates and as borrowing costs come down, these smaller names in the index, their borrowing costs go down. That should hit their bottom lines, and hopefully, as the market rally broadens out, they'll profit from that, as will our strategy.
Right. So thank you for sharing with us more about the strategy. So next, in terms of performance, how would an investor have done if he had adopted this strategy in the past few years?
So a long-term investor, let's say somebody who's been invested in the last 3 year for the 3-year period, at the end of, let's just say end of 2023, they would have outperformed the broad market index, right? Maybe we can, we'll do a little bit of a double click or a deep dive into that. So 2021 was a bull market, and the strategy outperformed that broad market index in the bull market, primarily driven by its exposure to quality and by its overweights in consumer discretionary and materials. 2022, bit of a different market, a bear market, and what we saw is that the strategy strongly outperformed in that bear market, primarily because of its slightly defensive tilt and because it wasn't holding any of the mega cap tech names that really led the markets down in 2022. Now, 2023 was a much different market.
Yeah.
So we had a strong bull market again.
Yes.
Right? Led by that Magnificent Seven, that small cohort of stocks that really drove index returns last year. And if you weren't holding those names or you were underweight like we were, because we do hold some, what you more or less, you underperformed the index. So we underperformed that broad market index modestly last year, primarily because of our underexposure to the Magnificent Seven. But what we saw is that quality tilt, it minimized that underperformance. And then, so again, net, when we look at that full 3-year period, that long-term investor over that 3-year period, even though we underperformed last year because we did much better in 21 and 22, they would have outperformed, over that 3-year period relative to the broad market index.
Right. So thank you for sharing with us more about the performance. And moving on to our last question. So for the year of 2024, what will advice be for investors who are looking to add more US equity exposure?
I might sound like a little bit of a broken record here, but really it's buy quality. Again, with how I see the markets this year with that modest slowdown in growth, it's really about finding those companies with the strong balance sheets that are highly profitable, with stable businesses that will help you weather that storm a bit. So buy quality is really my message.
Right. And with that, we've come to the end of our interview. Thank you, Jeremy. Once again, for investors who seek to generate a sustainable income stream using US equities, do check out the UBS US Total Yield Sustainable Equity Strategy. Thank you, everyone.